All right, everyone, welcome. So far, we've spent a lot of time focused on how to properly record and report a company's financial story. Debits, credits, financial statements, you know the drill. But today, we're going to shift gears. We're moving beyond just the numbers on the page to look at the systems that actually protect that story from the inside out. Think of it as the immune system for a business, a critical concept we call internal controls. I want you to picture this. Imagine a cool little startup. It's doing great. Sales are through the roof, new customers are signing up left and right, and there's plenty of cash coming in. From the outside, it looks like a huge success. But if you look a little closer, invoices are just getting paid, no questions asked, company credit cards are being passed around with basically no oversight, and here's the real kicker. One single employee handles all the cash, from taking it from customers to counting it to depositing it in the bank. This isn't just, a bit disorganized. It's a ticking time bomb of risk, just waiting to go off right underneath that shiny surface of success. So here's our game plan for today. First, we're going to really dig into that at-risk business to understand the problem. Then we'll introduce the professional solution, this formal system of control. After that, we'll break that system down into its 3 essential pillars, see how they work on the real world, and finally, we'll wrap it all up by talking about why this is your responsibility as a future manager or leader. Okay, let's dive into our first section. Because to really get why the solution is so important, you have to appreciate the danger. So let's pull back the curtain and explore those hidden vulnerabilities that can quietly bring down even a company that looks profitable on the outside. You see, the fundamental problem here isn't a lack of sales or profit. It's a total lack of structure. In that void, that chaos opens the door to 3 major dangers. First, you've got honest mistakes. They can start small, but they multiply, leading to bad financial data and, bad strategic decisions based on that data. Second, you have waste. Wasteful spending just becomes normal because nobody's really watching or questioning it. And third, and this is the most serious, this kind of chaos creates the perfect opportunity for deliberate fraud and outright theft. So, how do we fight this chaos? We can't just cross our fingers and hope for the best, right? A professional organization needs a professional, systematic solution. So let's introduce the formal framework designed to do just that: internal controls. All right, let's really break down this textbook definition because every single word here matters. The word system tells us this isn't just one single action. It's a whole web of interconnected procedures. Policies and procedures means these are formal, written down rules, not just, casual suggestions we hope people follow. And the ultimate goal? To protect the accuracy and integrity of the financials, making sure the story they tell is the true story. So a strong system of internal controls really has 4 primary goals. First, and most obviously, it safeguards the company's assets. This is the shield. It protects everything from cash in the bank and inventory on the shelves to your customer data. Second, it ensures compliance. This is all about playing by the rules, following laws and regulations to avoid massive fines or legal disasters. Third, it works to prevent and detect errors and fraud. It's like having a magnifying glass on your operations, finding those little bugs in the system before they become huge problems. And finally, all of these things work together to do one thing: guarantee accurate financial data. And that accurate data is the absolute bedrock of making smart, strategic business decisions. So, how do we actually build this system? What does it look like on a day-to-day basis? Well, it all rests on 3 fundamental pillars, and they absolutely have to work together. If even one of these pillars is weak, the whole structure can come tumbling down. And here they are. These are the 3 pillars that form the absolute bedrock of any effective internal control system: authorization, record-keeping, and separation of duties. As a future leader, it's not enough to just know the names. You have to understand the logic of how they work together. So let's take a closer look at each one. First up, we have authorization procedures. This is all about establishing clear lines of authority. It means that specific people are given the official power to approve certain types of transactions. For example, a department manager might be authorized to approve any purchase under, say, $5,000. But anything over that needs a director's signature. The logic is pretty simple. It stops an entry-level employee from, ordering a new Tesla for the company on a whim. It creates clear accountability. Second, meticulous record-keeping. Honestly, this is the heart and soul of accounting itself, and it is completely non-negotiable. This pillar ensures that every single transaction is backed up with proper documentation. We're talking invoices, receipts, purchase orders, the whole shebang. Why? Because this creates a clear, undeniable audit trail. The value here is huge. If a question comes up 6 months from now about a weird payment, you can go right back to the records and see exactly who approved it, when it was paid, and what it was for. It eliminates all the guesswork. And finally, and listen up because this is probably the single most important concept in preventing fraud, we have separation of duties. This principle is simple but powerful. No one person should control a financial transaction from start to finish. The person who approves an invoice should not be the same person who prints the check, and neither of those people should be the one who reconciles the bank statement at the end of the month. By splitting these tasks up, you create a natural system of checks and balances. It makes it exponentially harder for someone to commit fraud without getting caught by someone else in the chain. Okay, theory is great, but let's get practical. It's one thing to know the names of these pillars, but it's another thing entirely to see how they actually work in a very common, everyday business scenario. Let's put them to the test. This is a classic. It happens in every single business, big or small. An employee goes on a business trip, spends their own money or company money, and now they need to get reimbursed or account for it. Without good controls, this whole process is just begging for abuse. From little exaggerations on meals to completely fake expenses. This is where controls are absolutely essential. Now this slide, this is where it all clicks. Look at the poor control scenario. One person does it all. Maybe it's the employee's direct manager. They approve the report, maybe without even looking at it closely, they print the check, and they sign it. The opportunity for a mistake, or even worse, fraud, is just massive. Now look at the strong control side. This is a beautiful illustration of our pillars at work. Person A, the manager, provides the authorization. Person B, someone different in the accounting department, handles the record keeping and cuts the check. And person C, a senior manager, gives it one final review and signs the check. 3 different people, 3 distinct steps. See how that works? And this right here highlights the most common mistake I see, especially in smaller companies that are obsessed with being efficient. They think having one person handle everything is faster. But what they call efficiency is actually a gaping vulnerability. A manager approving their own expense report, that completely destroys the whole point of authorization. One person controlling the entire process from start to finish, that eliminates every single check and balance we just talked about. It's a classic, costly mistake, and it's one you now know how to avoid. All right, let's bring this all home and connect it directly to your careers. And I want to be crystal clear about this. This is not just a topic for the future accountants in this class. This is a fundamental leadership topic for every single one of you. I really want you to let this quote sink in because it's all about reframing how you think about controls. So many people see them as bureaucratic red tape that just slows everything down. That is absolutely the wrong way to look at it. Effective controls are an enabling force. They create an environment of trust where everyone can do their job with confidence, knowing that the organization's assets and its reputation are protected. That protection allows the organization to go out and achieve its mission. I really can't stress this enough. I don't care if you go into marketing, HR, operations, or if you start your own company from scratch. You will be responsible for implementing and following these procedures. You'll be approving budgets. You'll be managing company assets. You'll be submitting your own expense reports. Understanding the why behind these rules is what separates a good manager from a truly great and trustworthy leader. And so we'll end on this thought for you to carry with you. Internal controls give you the framework. They're the rules of the road. But rules by themselves are never enough. The best, most resilient organizations build a true culture of integrity, where every single employee from the top to the bottom understands why those rules matter. They feel a personal responsibility to do the right thing. You see, compliance is just following the rules because you have to. Integrity is doing the right thing even when nobody's watching. And your challenge as a future leader isn't just to enforce the rules, but to build that culture.